Hello and welcome to the Genuine Learning blog. My name is Melissa Galasso, and today we're going to talk about a brand new exposure draft that just came out from the GASB. The title is Certain Component Unit Criteria and Accounting and Financial Reporting for Internal Code Section 457 Deferred Compensation Plans. That is a mouthful. So what is going on here? Two relevant items that we have. First off, we have a practice issue that needs to be addressed, and then they have a secondary issue that kind of related to the first. So let's dive on in here. So this was issued in March of 2020, and comments are due April 10th. So this is a quick turnaround. This is really narrow scope, and it's addressing an issue in terms of cost and complexity. And in particular, it addresses something with the fiduciary activities rules, which obviously very important as people are in the middle of working through that tonight, right now. So the objectives of this standard are to increase consistency and comparability related to the financial reporting of fiduciary component units in circumstances in which a potential component unit does not have a governing board and the primary government performs the duties that a governing board typically would perform. This actually comes from an implementation guide question, kind of pulls in a little bit of issue there. And then to mitigate costs and costs associated with the reporting, certain defined contribution plans, defined contribution OPEB plans, and other employee benefit plans as fiduciary component units, and then addressing Section 457 plans regarding relevance, consistency, and comparability. So it's really one big issue that has tentacles that kind of come off of it. So we need to know the background because this is where it gets really confusing. I read the exposure draft the first time and I was like, what? Totally confused. And then I read the basis for conclusion and I was like, so every once in a while, it's actually really helpful to read the basis for conclusion. Those two appendices do a great job of explaining the theory behind it, the background, and then also why they did what they did. And then it totally clicked for me. So I definitely recommend the basis for conclusion. So first off, GASB 14 provides guidance on the identification of component units, right? So going all the way back, how do we know what is a component unit, the definition, and we go through the countable concepts and things of that nature. GASB 84 provides guidance on the identification of fiduciary component units and fiduciary activities. So if you think about it, there is the path where you meet the definition of a component unit, and then the path that you don't, where you have to look and evaluate control in that flow chart. Well, GASB 84 amended the requirements of GASB 14 regarding the financial benefit or burden by adding a criterion to indicate that a primary government is considered to have financial burden if it is legally obligated or has otherwise assumed the obligation to make contributions to a pension plan or an OPEB plan administered through a trust. So that was a change in 84 to when you would have that benefit or burden, which is a criteria for when you are a component unit. Well, then we had an implementation guide come out for Implementation Guide 2019-2, and it addressed a very specific situation where it was related to not having a governing board, and instead the government took the role of a governing board, and they did it two ways. They did it first where it was just a pension plan, and then they did it again where it was a defined contribution plan. And so it addresses a situation where some defined contribution pension plans and defined contribution OPEB plans that are administered through a trust that don't have a governing board, however, the employer is legally required to make contributions, would be reported as a fiduciary component unit. This did not go over well at all. They received a significant amount of feedback from stakeholders that would increase cost and complexity because prior to this, they would not have considered it to be a fiduciary activity. So stakeholders expressed concerns related to the cost, including audit cost, of creating these as fiduciary component units. So they went and did some research, and this is where I learned a lot by reading the basis for conclusion. They believe that what their answer they came to is correct. So they're not saying that the answer that they have in the implementation guide or in the standard is wrong. But what they're saying is their cost benefit might not have been strong enough. So based on the expected benefit and perceived cost information, they added a technical agenda item to review potential ideas on how to address this. So how the absence of a governing board should be considered in whether a primary government is financially accountable, and then the applicability of component unit criteria for defined contribution, pension, OPEB, and other employee benefit plans. So when we go through this, when we look at the impact, it requires that for purposes of determining whether a primary government is financially accountable, the absence of a governing board should be treated the same as the appointment of a voting majority of a governing board if the primary government performs the duties that a governing board typically performs. This is consistent with what the implementation guide said, what the GASB 84 said, and how 14 was amended. What they did, though, is add an exception. And they put a potential component unit that is in a DC plan, whether it's pension or OPEB or another EBP like a Section 457 plan, would be an exception to the rule. So they would not in those scenarios. So they kind of carved them out to go back to the treatment that we had before. Not because what they thought the new treatment was bad. They just felt that based on the complexity and the cost element of it, that the benefits did not outweigh the cost based on the information they received. And then it requires that the financial burden criteria in GASB 84 only apply to defined benefit pension plans and defined benefit OPEB plans that are administered through a trust. Again, carving out those DC plans. And then for Section 457, sort of an offshoot of this while they were in there, it requires that all accounting and financial reporting requirements relevant to pension plans be applied to Section 457 plans that meet the definition of a pension. Again, going back, we had a 457 plan exposure draft prior to this. However, it specifies that all accounting and financial reporting requirements relevant to pensions be applied to benefits provided through Section 457 plans that meet that definition. So it supersedes the remainder of GASB 32 and requires investments to be measured as of the end of the reporting period in all circumstances. So a little bit of clarification there. So as you can see, it is a really interesting history and coming up with just a cost and complexity decision. So they don't disagree with what they originally said, but they are understanding of the cost and complexity of adding this and the fact that very often they will get standalone audits. And so as a result, they felt that this was something that would improve the financial reporting overall. So again, quick turnaround time because GASB 84, we're on the heels of it right now. So we definitely want to make sure that we are doing everything that we need to do so that people are successful in implementation. All right, so that's it for today's Genuine Learning blog. I hope to see you on a future blog. Have a great day, guys. Bye-bye.